in this environment, I think there are a lot of opportunities in real estate, but there are a lot of pitfalls. There are a lot of dangers. You got to understand you are playing with fire. And if you're not an expert, if you're not educating yourself, I think, there's a possibility that when all this is said and done, that you're a victim as a result of just ignoring these macro types of cross currents that we're talking about.
It is my pleasure to welcome George Gammon back to the show. It's good to have him. And he has a question for you. Do you think that raising interest rates could actually create more inflation? That sounds counterintuitive, George. What do you say about that?
Well, I need to give all the credit to my good friend Joseph Wang. And for those of your viewers or listeners who don't know Joseph, you should definitely follow him on Twitter. You should go to his website, which I believe is thefedguy.com. It's his blog. And he used to run the New York trading desk the trading desk, at the New York Fed. So why is that important? Because we hear all the time about quantitative easing, or now maybe tapering or quantitative tightening. And that's the process of the Federal Reserve buying or selling treasuries or mortgage-backed securities to the big banks mostly. So Joseph was the person that was actually in charge of doing that. So he actually did QT and he actually did quantitative easing. So to say that he understands the plumbing of the financial system is a wild understatement.
Yeah.
Yeah. He just spoke at the last event we had where you were there, the Rebel Capitalist Live.
Yep.
And he has a very interesting concept. So in order to understand this well, we've got to go back prior to the GFC. Because prior to the GFC, the way the Fed raised or lowered interest rates is they would simply go out there and they would buy some bonds that would create additional bank reserves. And therefore, theoretically, this is kind of how it worked. Then if they created more of quote unquote base money or money supply, then that would lower the interest rates because the demand for those bank reserves would be lower. If they went ahead and sold the treasuries or mortgage-backed securities from their balance sheet, that would mean fewer bank reserves. Therefore, that would most likely increase interest rates. That's kind of how they micromanaged Fed funds. But after the GFC, they couldn't do this. Why? Because they started quantitative easing, which was just flooding the entire system with bank reserves. So effectively, the interest rate would have never got above zero. Because there was way too many bank reserves, and the banks just didn't have any use for all of these reserves, and they can only expand their balance sheet so much, meaning create more loans in the real economy. So the Fed, in order to raise interest rates in the future, they had to come up with a new system. And what they created is something called IOER, or IOR now. That's just interest on reserves. So the Fed said, all right, big banks will go ahead and pay you for holding your reserves at the Fed. So let's just say JP Morgan has $10 billion worth of reserves. They stay at the Fed, and the Fed pays them now, let's say 5 basis points or whatever it would be, 1%, 2%, something like that. So the idea is that they would not lend money at less than what they could get paid at the Fed. And therefore, this kind of puts a floor on overall interest rates, at least short-term interest rates in the real economy. So what inadvertently happened, it's like all things regarding central planning, in that when the planners come out with these possibly good intentions, it leads to a massive amount of unintended consequences. So one of the unintended consequences, is, if you think about it, is if the Fed now raises rates by increasing IOR, let's just say that they raise it to 2%. Well, in the past, what would happen, because the system it wasn't completely flushed with bank reserves, is banks were actually incentivized to compete for customer deposits. So why was this? It's not that banks lend out deposits. That's a fallacy. That's not really what happens in the real world. But when a bank gets a deposit, which is a liability, a dollar liability, they also get reserves to back up that deposit that was transferred to them. And then they can lend using these bank reserves. They can create more loans because those bank reserves back up the additional lending. So and that's a cheap way. So if you borrowed it at repo, or you would pay the customer deposit maybe less than you would have to pay to borrow those funds from another bank if you needed to, and therefore it was always a cheap way of funding your expansion of, or further expansion of the balance sheet. And I'm saying that in technical ways. I'll try to simplify it. It was a very cheap way for banks to create more loans. Okay. That's the bottom line.
Right.
So what would happen is these banks would compete for these bank reserves. And therefore, if interest rates went up, if Fed funds went up to, let's say, 4 or 5%, then the interest rate that they would pay you, the banks, for a checking deposit would go up as well. So if overnight rates were, let's say, 5%, then banks would pay you probably, I don't know, maybe 4% or so to keep your money right there in a checking account. I'm sure for those of us who are our age, Jason, we can actually remember that when you used to get actually paid to have your money in a bank.
You used to be respected if you were a high depositor or any depositor.
Any depositor,
when I was a kid, I had a savings account. They used to always give me treats to have a little passbook account as a kid. I mean, I had no money.
Yeah, and if you wonder why that's just gone the way of the dodo bird, it's because banks really don't care about your deposits anymore. They don't need them at all. Right. Where before, that's the whole point here, is they needed your deposits. They were incentivized to gain your business. So in a world where they don't need your deposits, they're not going to be competing for them. So there's no reason to offer you a higher rate of interest for your savings account or your checking account. So what we have is, before the GFC, if overnight rates, Fed funds went up, so would the rate that they were paying depositors. So the delta was pretty much always the same. But now with this environment of IOR, where they've done just trillions and trillions and trillions of dollars worth of quantitative easing, is the rate at which they pay you will most likely stay the same. But the rate that the Fed is paying them for those bank reserves increases. So you see, let's just say before that the delta was about 1%. But now, let's say they're paying you nothing, and the Fed starts paying them 5%. The delta is going to be 5 percentage points, 500 basis points. The bank's going to be making in pure profit, where they would not have had that profit before. So then the question becomes, well, what are they going to, if the Fed raises rates, what are the banksters going to do with all this additional profit? And the answer there is they're most likely going to buy treasuries, because this is the quote unquote pristine collateral that I always talk about with Jeff Snyder. And for a variety of reasons, banks are incentivized to hold treasuries as opposed to these bank reserves, even if they can, you would assume that they can get a little bit higher interest rate by holding those treasuries, and they're just as quote unquote safe. So the next question becomes, who are they buying these treasuries from? So we all have heard about the debt ceiling debate, and Janet Yellen can't issue as many treasuries as she'd like to at auction because of the debt ceiling this, the debt ceiling that. So there is a good chance that in the future they're auctioning off fewer treasuries, the Treasury and Janet Yellen. So therefore, these banks would most likely have to buy the treasuries they want or need from the private sector, so non-bank entities in the private sector. Okay, so if JP Morgan, Jason, let's say buys a treasury from you, let's say you own that treasury, and let's just say that it's worth $1,000. Well, they're going to say, okay, Jason, and let's just say that you have an account with JP Morgan. Let's just say it's Wells Fargo. It's probably retail bank is better. So you have an account with Wells Fargo. Wells Fargo comes to you and says, Jason, I want to buy your $1,000 worth of treasuries. You say, okay, cool. So what do? They credit your account an additional $1,000, and then you give them that treasury, and that becomes an asset on their balance sheet. And the new bank liabilities that they increase your checking deposit account by, that becomes your additional asset. It's kind of an asset swap. So, but what most people don't realize is that's $1,000 that didn't exist before, because it's way different when a bank does a transaction between two banks, and a bank does a transaction between a bank and a non-bank entity in the real economy.
Right.
See?
So they've just created that $1,000 out
Correct.
of thin air then?
Correct.
Okay.
Yeah, that
So,
$1,000 did not exist. In other words, M2 money supply just increased, broad money supply just increased, and the amount of dollars that are circulating in the real economy chasing goods and services also increased.
okay, so yes, so now there's a new $1,000 in existence. There's another $1,000 in demand for treasuries, right? So make the connection totally understandable of how the higher interest rates create more inflation, whereas most people think it's the opposite.
Well, this is an alternate. There's cross currents here.
Yeah,
So
of course.
there's definitely deflationary pressures that are a result of higher interest rates. But in this environment, there are also inflationary pressures. It's just a matter of which cross current wins in the end. So what happens, just quickly here, kind of the Reader's Digest version of what I just said, is Fed raises the IOR. That's how they raise interest rates. So let's say they raise the rates to 2 or 3%. That means the delta on the bank's reserves and what they're paying the depositors increases. That means their profit increases. Bottom line, they're making more profit. So what do they do with that profit? They most likely will take that profit and buy treasuries from non-banks in the real economy, just average Joes and Janes, corporations, hedge fund managers, etc. The process of the big banks buying treasuries from a non-bank entity increases the money supply. And an increase in money supply usually results in consumer price inflation if the amount of goods and services don't increase at the same rate. So interest rates go up, profit goes up, the buying of the treasuries from banks to non-banks goes up, which increases the amount of dollars and therefore puts higher pressure on consumer price inflation.
So, yeah, the question is which cross current wins? You know, that's basically a war between the two. Like I always express the war of technology versus bad fiscal and monetary policy. So, which one would win, George? I mean, how strong does one or the other cross current have to be? How do we know which way it's going to go?
I think you just got to, the devil's in the details. You got to compartmentalize. So I think asset prices will go down that require debt. Because like if you're getting an auto loan or a home loan, or if your margin account with buying stocks, the interest rate's going to go up. So therefore purchasing power goes down. And if purchasing power goes down, all things being equal on the supply side of the equation, then most likely prices go down. But with the stuff that you don't need to borrow to buy, the prices of those items go up. So groceries go up. Maybe used cars that you might not be using leverage, those prices go up. Insurance goes up. College tuition goes up. Rents go up. Those types of things go up while the asset prices themselves most likely go down in that environment.
Yeah. Okay. So I want to ask you a very broad question. And I know you have guests on your shows that go from one side to the other. You do whiteboard videos that, sort of explain this possible scenario and an opposite possible scenario, right? In two different videos. And the titles you have are pretty catchy, you're doing a great job with that. But what does George think the future holds? How does our world and I mean, maybe we can talk about, as far as Great Reset and all that stuff, but just the economy, right? And, prices, investments, things like that. How does that look in 3 years or 5 years from now? How does that look to George?
I just think higher prices, fewer goods and services. So standard of living goes down.
Yeah, and I agree with you, but do you mean higher prices of consumer prices and asset prices like real estate?
That's a difficult question. It's a far easier question to determine what's going to happen with consumer prices.
Right. Well, that's why you're here, to answer the difficult questions.
It really it really becomes a political question.
Yep.
And that's what we were saying at Rebel Capitalist Live when we were there, is in order to answer economic questions now, you've got to answer political questions first.
Because the market is so distorted by the political agendas. Yeah. No question.
Yeah. So, what happens to interest rate? But then I think a further question would be, if they raise interest rates, what happens to the stock market? And then how far can they raise interest rates, depending on if the market has some sort of spasm, like we saw in March of 2020. And then the question becomes, well, what is the rate of inflation while the Fed is surveying their options? If the stock market, let's say, crashes by 20% in, let's say, 3 weeks, is inflation at 7%? Is it 10%? Is it 4%? Because that will really factor into their policy response. And likewise, the government. And then, how effective is more quantitative easing or dropping rates back down to zero going to be when their high water mark was already 120 billion per month? The way QE works, it's just like a drug, is to get the same effect, you usually need more and more and more and more. So does the market shrug that off if they just come back with 120 billion? I would say most likely, and maybe flatline. So then the government would have to come in and do another CARES Act, let's say 2.0, trillions of dollars of deficit spending. Now, can they do that in a world where there's 10 or 12% headline CPI? I don't know. I don't know. I doubt it because the politicians, there's no way they can get elected in that type of environment. I mean, you look at Jimmy Carter or something like that, and that's the fastest way you can not get reelected, is to have high rates of consumer price inflation. So then they'll probably err on the side of lowering asset prices. But if they're lowering asset prices, they can't do that, or they can't allow the market forces to take over, because then you'd have a big crash. And now, because the real economy is so dependent upon asset prices, then that would really collapse the real economy as well. So they'd try to most likely create this soft landing environment where maybe the stock market goes down by 20% over the next year instead of the next 2 weeks, and therefore put a little bit of headwind on inflationary pressures to try to buy enough time for the politicians to be reelected. Now, what we can definitely ascertain from this worldview is that the central planners will be doing more and more meddling, not only in the real economy, but also with the price of money, which is an interest rate. And the price of money, or money in and of itself, is 1/2 of every single transaction. So if you're manipulating the price of money, essentially you're manipulating all prices of goods and services and assets in the entire economy, which means incredible economic distortions. It means malinvestment and a misallocation of resources. So that creates an environment where the amount of goods and services being created goes down. And that's, in my opinion, the measurement of wealth. You can have all the gold or Bitcoin in the whole wide world. You can have all the US dollars. You have $1 billion, but if you don't have access to goods and services, then you are poorer by my definition. So that's the environment I think we're headed towards. And that's kind of me thinking out loud as far as trying to layer over some game theory as to how 2022 might play out.
George, let's drill down on that statement you just made of the price of money is half of the price of anything, right? I think that's the way you just said it. And I keep saying that to real estate investor clients of ours, that, people are getting, the thinking, rightfully so, that the market is frothy, man. I mean, prices have risen so much, right? But of course, in real terms, not as much as people think, but we all understand that. But, the question is, do you want the real estate cheap or do you want the money cheap? So for example, if you're looking for a crash and you're waiting for that big correction to happen, and say that correction is 20%, but it comes with an interest rate that is 30% higher, relative to the rate today, right? Is it really half the equation, the price of the money? And does that apply to all things or only credit-based assets like real estate?
No, it applies to everything when you're trying to figure out price discovery. Because like that, you have a mic right there. It's a Shure mic. I can read that. And you've got some artwork back there. Money was 1/2 of that transaction when you bought that mic.
Right.
Well, if the price of money is 1% or zero, compared to if the price of money was 20%, would that affect the price that you paid for that mic?
Yeah.
The answer is yes.
Yeah, of course.
Therefore, if we don't have free market interest rates, if the market doesn't set the price of money, then it's impossible to definitively know the price of anything that you use money to buy. whether
Right.
it's that mic or the house that you're in.
Yeah. So that's really interesting because we're under this illusion that we have this free market of prices, but when the money isn't free, which it hasn't been in over 100 years,
Or at least free
uh,
market interest rates, right?
right. Interest rates, they really are, the government or the central planners, I should say, are price fixing in essence, right? Or price controlling, right?
Yeah.
Yeah.
Yeah,
Very interesting.
which is incredibly ironic, because if you talk to any PhD economist, even a Keynesian, monetarist, Austrian, it doesn't matter from what school of economics you come from. Even Krugman, for heaven's sakes,
Yeah.
if you ask Krugman about price controls, he would say that's not good. That's going to lead to very, very bad things. But yet somehow these same PhD economists think that if we have price controls on money, then it's a good thing.
It's crazy. They just believe in this managed economy, which is just, it's ridiculous. George, you've got a big event this weekend in Washington, D.C., right?
Yes, well, it's not my event, but I will proudly be attending, because for most of your viewers, or for your viewers who aren't familiar with my YouTube channel, the George Gammon channel, I talk a lot about macroeconomics and kind of what happens behind the scenes with quantitative easing in the repo market, and inflation, deflation, the dollar, gold, Bitcoin, etc., through the lens of free market economics. But my Rebel Capitalist channel, I talk about those things. That's the second channel, but I really talk about freedom and liberty, because I think that's under attack right now, not just in the United States, but globally, especially. And I see that the world is moving closer to authoritarianism. And I think that's a very dangerous, slippery slope. So I'm trying to do everything I can on YouTube with my audience, with creating content. And I'll be doing everything I can this weekend to really stand up for the values this country was built on. And that's really prioritizing freedom over safety. And it's really just standing up for the sovereignty of the individual, as opposed to this move towards central planning and authoritarianism in the name of safety. Yeah. So this weekend, it's a huge protest going to be in DC, peaceful, obviously, just a march. And it starts at the Washington Monument. It goes to the Lincoln Memorial. It's on Sunday, January 23rd. It's called Defeat the Mandates DC. The website is defeatthemandatesdc.com. And I'm going to be there. There's going to be speakers like our good friend Chris Martenson, Brett Weinstein, I believe, is speaking. I'll try to keep it YouTube friendly. So a lot of the doctors that Joe Rogan has recently interviewed that we cannot mention on social media.
The thought police are after us.
Yeah,
it's unbelievable.
Yeah, they will be there speaking to the crowd on the steps of the Lincoln Memorial, and it's just people standing up and showing the central planners that we don't like the mandates. I think it's very logically consistent to just be totally okay with we'll call them medicines, but be extremely opposed to medicine mandates. So that's what I'm going to be doing this weekend. So for any of your viewers who are in the DC area or want to come out and support the cause, just go to defeatthemandatesdc.com.
And that date is this Sunday, which is the 23rd, I believe?
Yeah, January 23rd, correct.
Right. Excellent. Thanks for sharing that, George. You mentioned Chris Martenson, some of the topics we just kind of covered. Wanted to mention, of course, Rebel Capitalist Live. I was honored to speak there. That was a lot of fun, that event. You did a great job with it, George, so hats off to you on that.
Thank you.
And Rebel Capitalist 3 is coming up in Miami. You're going back to Miami. And what's the date for that one?
I think it's the last weekend in June. People could just go to rebelcapitalistlive.com and check it out.
Good stuff. But I also wanted to mention, because Chris Martenson spoke at our last collective mastermind retreat. And of course, you, myself, and Ken McElroy formed the collective, which is our mastermind group together. And we've got a good event coming up first weekend of February, and that will be in Florida. And it's going to be a great time. You've lined up Jeff Snyder and Lynette Zhang for that one, right, George?
Yeah, that's correct. Yeah. So we've got the person that I think is one of the foremost experts in the gold market, and then another individual that is, in my opinion, I think most opinions, the foremost expert in the repo, the dollar funding markets, how the plumbing of the financial system actually works. And I want to just emphasize to real estate investors, you have to know this stuff. At least have to understand the concepts behind how dollars are created, what the repo market is, quantitative easing. I remember, and I'm sure you remember this better than I do, Jason, back in 2005 and 2006, I met some incredibly sophisticated real estate investors, but they would just they knew real estate so well, but they completely ignored macro. I mean, they didn't even pay attention to interest rates. They didn't pay attention to the Fed. They didn't pay attention to, just oblivious to it all, because they just thought, if I just know real estate and building apartment homes or building single family homes or buying and flipping or renting out, and everything's going to take care of itself. I'm really good at real estate, and we always know that housing prices always go up. So what's there to worry about? But then we know that the GFC came in like a tidal wave, like a tsunami, just completely overwhelmed any good decisions that a real estate investor was making at the time. I should say most real estate investors, because a lot of real estate investors were prudent with their LTV ratios and whatnot, actually came out not only unscathed, but came out better because they were able to buy the cheap assets when they went down in price. But for the majority of real estate investors, they completely ignored macro. They got overly aggressive, and as a result, they got wiped out. So in this environment, I think there are a lot of opportunities in real estate, but there are a lot of pitfalls. There are a lot of dangers. You got to understand you are playing with fire. And if you're not an expert, if you're not educating yourself, I think, there's a possibility that when all this is said and done, that you're a victim as a result of just ignoring these macro types of cross currents that we're talking about.
Yeah, I couldn't agree more. And George, a lot of that comes with joining a mastermind group like the Collective. I'd just like to put on the screen here while we talk, people can just look at this in the background, just show them our last Collective event. That was our Scottsdale event. And we went car racing. We had a fashion show. We had great speakers, Robert Kiyosaki, Mark Victor Hansen, of course, you, myself, Ken McElroy, Robert Barnes,
Chris Martenson.
Yeah, Chris Martenson.
Carrie Lake. The
Yep.
gal running for governor. It's an incredible event.
Yeah. Ashley just sent me a note, I think it was last night or Saturday night at a Trump rally. Trump brought up Carrie Lake to speak. So, these are big name speakers. We get big name connections. And when you join a mastermind group, you get access. That's really the key. It's access, right? You can just accelerate not only, of course, your learning curve, but your connection curve.
Yeah, right. Your network.
Yeah, your network. And this right here, what you're seeing was an event. There's Robert Kiyosaki with Ken McElroy, and this was at Ken's office. So if people want to learn how to syndicate apartment complexes, big deals, whatever it is, it's not the how, it's the who. And being part of the Collective Mastermind really gives you access to the who, which is a great thing. Yeah.
Very well said, Jason.
Good stuff. Well, one more thing I want to ask you maybe is about the Great Reset. There's, of course, been so much talk about, oh, by the way, we had lunch at Robert Kiyosaki's home, at his beautiful home.
There's Chris Martenson.
Yeah. What's that?
There was Chris Martenson.
Oh, yeah. In the video. Yeah. But that's the home of Robert Kiyosaki right there. He hosted us at his house. That was just awesome. So yeah, good stuff. But about the Great Reset, maybe you can just end with any of your more recent thoughts on that. You came on and did a show with us about that before, but just any new updated thinking about the Great Reset.
Yeah. Well, so by the way, the website, Jason, it's the Collective
Advisors.
Advisors.com.
Yeah.
Okay, thecollectiveadvisors.com for the people who want to check it out. Yeah, I just sent out a tweet today from a very young politician. I think he was just elected in the Netherlands.
Yep.
And this kid, I'm not sure how their political system is set up there, but he came in and just grilled their prime minister. I mean, just ran him over the coals. It was a verbal beating like I have not seen before. And
It takes a lot of guts
it takes
for that Dutch guy.
huge
Yeah.
guts to do that. And so what was the gist of his verbal beating, let's say, of this prime minister? And it was really to highlight the prime minister's relationship with Klaus Schwab, who's really pushing this Great Reset agenda. And so initially, and you can see this online, maybe you can put a link in the show notes or something to the video of the kid just really spitting fire at this guy. But the kid starts off by in their parliament, I believe, and saying that, what are your thoughts on this Great Reset agenda? And the prime minister says, oh, I don't know anything about it. It's just one of these little conspiracy theories. You probably saw that on YouTube, very arrogant, very dismissive. Yeah. And the kid says, oh, really? Because right here, I've got a letter that you sent to Klaus Schwab thanking him for his book on the Great Reset agenda. The prime minister's like, well, he says, I get a lot of books, basically. And, I was just being polite. And he said, yeah, but here in the letter, you say that you agree with a lot of what was said. So either you're lying to me right now or you lied to Klaus. Which one is it?
Yeah, right. Wow.
And he's like, well, I was just trying to be, polite type thing. He's like, well,
it's a form letter. He says that to all book thank you notes that he sends, right?
Yeah. And I'm paraphrasing. Everyone really has to watch the video. Yeah. But then he goes on to say, well, how can we really trust your level of competence if you're stating how you approve of this book that is trying to move us away from a democracy into a world that's completely controlled by global elite and corporations? The guy just had nothing. He couldn't go anywhere with that. But my point is, what does the guy do after that? He probably gets on the phone with Klaus and he says, listen, we got a big problem. And so then they try to take out the dislike button on YouTube. Yeah, as an example, which we've seen. And I'm not saying they've done this now because we saw it in the past, but this is an example of, I think, how they respond to these things. But my main point that I'm trying to make with your audience is the Great Reset agenda is real. This is not a conspiracy theory. This is something they are talking about. Don't take my word on it. Just Google it. Go to the World Economic Forum.
Go to their website. It's right on the website.
Yeah, this is not tinfoil hat stuff. And this is basically a move towards economic fascism. That's what they're proposing. It's this, what they call it is a partnership between the private sector and the public sector. That's just,
I guess that's what Mussolini would have called it too.
Yeah,
right?
Yeah, exactly. And so this is the way they believe we can move into this socialist utopia. And I would assume for most of your listeners or viewers, they could be on the right or the left, but they definitely favor free market capitalism. And they do not favor us moving globally into a socialist utopia. So this is something of deep concern. But what is really great and kind of that light at the end of the tunnel, and something I think we should all be excited about, is we now have these young kids. This guy was maybe 30 years old, this politician that I'm referring to. And we have these kids that are really standing up and pushing back, and they're pushing back against the authoritarians, and they're standing up for freedom, liberty, and free market capitalism. And I think that is incredibly exciting.
Yeah, that is very exciting. But again, it's a small number. Let's hope that number increases. Because
it is, but I think I always say that I think it's a silent majority.
Right.
Because I think this vocal minority is out there, pounding the table on mandates and, totalitarianism on social media. And obviously that's the position of most of the social media platforms and in the mainstream media, the education. But I think if you just went to Dallas or Oklahoma or somewhere in the Midwest, just most Americans, go to Florida for heaven's sakes, and just ask 100 people if they agree with this authoritarian approach, and regardless of what their political views are, regardless of what their views are to the efficacy of, we'll call it the medicine, they would say, no, we don't like this. We're very concerned about what's happening in the world around us today when in regards to just individual sovereignty, freedom, and liberty.
Yeah, no, that's a human need, a human right.
Yeah,
it's an inalienable right. What's interesting is that this crazy woke left, the like the crazy left, who's just caused people to realize the Democratic Party has just gone off the deep end, but this small vocal minority of that group, hopefully it's a minority. What's interesting is that if you look at, like, I'll call it the bumper sticker metric. In the old days when people used to put bumper stickers all over their cars, and some still do crazily, you'd see a bumper sticker that would say, "You can't hug your kid with nuclear arms," right? And world peace and coexist. And there'd be another bumper sticker that would say, "Question authority."
All right.
And it's interesting that back then, those were all one kind of belief system. One person would think all those things. But now it's like you have this whole group of that would say those first three things, but then they'd say, just give up your authority to the state. It's absolutely crazy.
Yeah. And you see what's happening right now with the tennis guy. They booted him out of Australia, so he can't play in the Australian Open.
Right.
But now they're not letting him into France.
Right.
So he's not going to be able to play in the French Open either.
I didn't know that part. I knew about the Australia part. But what's so ironically hypocritical about all of these things is, like, the Australian government is worried that he's going to make people question the government, right?
That's what it's about. It's not about health, because I did another story today on the Rebel Capitalist channel about data that is on the website for the government in Ontario, Canada. And they're keeping very good track of the recent spike. And you guys know what I'm talking about. We'll try to keep it YouTube friendly here.
The thing that's going on.
We'll call it the scariant. And
there you go. That's good.
So what you'll notice is that they keep track, and they do an apples to apples comparison. So they take the amount of cases for a specific group, we'll call them the medicated, and then the other group, we'll call them the unmedicated. And then they compare it to the overall population of that same group. And they show that cases per 100,000 are far higher with the group that is medicated.
Yeah.
So the argument that by preventing this tennis star from coming into the country, or preventing him from coming into France, is somehow going to benefit health compared to some other tennis star is absurd. It's absolutely absurd.
None of this is about health. If it were about
if it's
health,
not about health, then what is it about? It's obviously just about obedience.
Yeah, right. Absolutely. And I would urge anybody listening, and George, I hope you follow this Twitter handle, which is Peter Sweden. He just has some great stuff. He's a Swedish reporter, and he just reports on all this absolute psychosis that's going on in the world. And he said they were concerned that the tennis player would embarrass the government. Well, this is exactly what tyrannical dictators have done throughout history. They've squashed those people, right?
Yeah, that's right.
And that's what they're doing now. It's crazy. But I tell you, when I had it last week, I was really glad I could borrow some of that stuff from my horse, because it made me feel better almost immediately. So
enough said. We got to keep it.
Got to keep it PG-13, right?
YouTube 13.
Yeah, exactly.
Or YouTube 1984. Maybe that's better.
YouTube 1984, exactly. But my horse was very generous and loaned me some of his stuff. And I got that right on Amazon, amazingly. So we'll see, man. Okay, well, hey, give out that website one more time for your Sunday thing, and just so people can come and join you, and they'll meet you out there.
Yeah, I'll be out there doing the interviews, and just definitely come up and say hi. The website again is defeatthemandatesdc.com.
And of course, you can be found on YouTube, and everybody knows you already in my audience. So, George, it's always great to talk to you, and we'll see you soon, buddy.
Likewise. Thanks for having me.